Gold isn't going up. The dollar is going down. That sounds like semantics, but it changes everything. Because for most people, price charts tell the story backward. We're trained to think the currency is stable and assets fluctuate around it. Gold rises, stocks fall, dollars sit still. But history shows the opposite. Gold doesn't move much at all. What moves is the measuring stick. When gold appears to explode higher, what you're really watching is purchasing power disappear. The metal stays the same. The currency doesn't. That's not theory. It's math. In the 1970s, gold didn't suddenly become 20 times more useful. The dollar lost most of its value in less than a decade. Here's why this matters to you now. When headlines talk about gold at 5,000, 10,000, even higher, they frame it as speculation, a bubble, mania. But that framing hides the real risk. If gold is the constant and the currency is the variable, then rising prices aren't a warning sign. They're a measurement. But here's the part nobody explains clearly. If this is a numeraire shift, not a rally, then traditional price ceilings don't apply. And that changes how far this can go. What most people miss is that this isn't about predicting a price. It's about identifying what's being measured. Markets assume the dollar is the fixed point, the neutral ruler. Everything else moves around it. Gold goes up. Assets fluctuate. Currency just exists in the background. But that assumption only works if the ruler itself doesn't shrink. History shows the opposite. When monetary systems fracture, currencies don't signal their weakness against each other. They fail silently, together. Exchange rates stay calm while purchasing power erodes underneath. That's why cross-currency charts feel reassuring even as everyday costs rise. They're comparing one weakening unit to another. Here's where the framing matters. If gold is the constant and currency is the variable, then today's price action isn't speculative behavior. It's recalibration, a measurement adjusting to reflect reality. The same process played out before, slowly at first, then all at once. And notice the pattern. The discussion isn't about productivity or innovation. It's about debt, balance sheets, and credibility. Systems that rely on confidence hold together until confidence becomes expensive. When that happens, markets don't ask permission. They reprice. So the real issue isn't how high gold can go. It's whether the measuring stick can still be trusted at all. What comes next looks extreme only if you ignore the math. When people hear numbers like 10,000 or 100,000, they shut down. It sounds absurd, but that reaction comes from anchoring to a world that no longer exists. The mistake is assuming today's price environment has limits simply because the last one did. There's a historical precedent for this kind of repricing, and it didn't unfold gently. In the 1970s, gold didn't rise because investors suddenly loved it. It rose because the dollar collapsed in real terms. A move from $35 to $800 wasn't a rally. It was a reset. The currency lost nearly all of its purchasing power in less than a decade, and the price simply caught up. Here's the key detail that reframes everything. If the same percentage move were applied today, the numbers stop sounding conservative. What feels like an extreme target becomes a baseline outcome. And the early stages of that process are already visible, not in hype, but in acceleration past levels that once seemed impossible. But here's the part most people miss. These moves don't scale linearly. Once the psychological ceiling breaks, price discovery speeds up, not slows down. Because at that point, the market isn't debating value anymore. It's recalculating reality. There's a moment when this stops being about numbers and starts being about power. That moment arrived when money itself became a weapon, when sovereign assets could be frozen, seized, or neutralized based on political alignment. The rules changed. Reserves were no longer neutral. They were conditional. That single shift forced a rethink across the global system. If dollar reserves can be immobilized, then holding them isn't risk-free. It's permission-based. And once that realization sets in, the logic is unavoidable. You don't hedge against sanctions with promises. You hedge with assets that can't be frozen by keystroke. This is where gold quietly re-enters the center of the system. Not because it's efficient, not because it yields, but because it has no issuer, no allegiance, no off switch. When held physically, it exists outside the digital and legal reach of any single power. Here's why this escalates fast. The moment one major reserve holder acts on this logic, others are forced to follow. Neutrality becomes scarce, and scarcity changes behavior. What was once diversification becomes defense. This isn't a protest against the system, it's adaptation to it. And once adaptation starts at the sovereign level, the consequences ripple outward. Because the market isn't repricing gold, it's repricing trust. Once trust starts eroding, capital looks for alternatives. And here's the problem the system runs into fast. There aren't many. On paper, investors can rotate between sovereign bonds. In reality, those balance sheets all share the same weakness. Debt loads are higher everywhere, demographics are worse, growth is slower, and the math doesn't improve just because the flag changes. So when confidence in one issuer fades, it doesn't neatly flow to another. It leaks out of the category entirely. This is why the bid for gold isn't just geopolitical, it's structural. There is no large, liquid, risk-free bond market left that isn't tied to political decisions and fiscal promises. Now notice what's happening underneath. Rising debt doesn't trigger panic immediately. It triggers doubt, and doubt changes time horizons. Investors stop thinking in quarters and start thinking in preservation. Yield becomes secondary to solvency. Return becomes less important than survival. This is the crisis of alternatives. Capital isn't choosing gold because it's exciting. It's choosing it because the menu is empty. When every fiat option carries similar risks, the non-fiat option gains relevance by default. Here's where the pressure builds. Once enough capital leaves the bond market, yields rise. Rising yields worsen debt dynamics, and that feeds back into more doubt. The loop tightens quietly, and gold sits in the middle, absorbing what the system can no longer hold. This is where strategy replaces theory. Some countries didn't wait for the system to crack. They moved early, quietly, over years, not months. They reduced exposure to paper promises and increased exposure to assets they could actually hold. And the results matter. When pressure arrived, those balance sheets didn't collapse. They flexed, sanctions hit, access was restricted, predictions of currency failure filled the air, but the collapse never came. Not because of clever policy, but because reserves were structured differently. Here's the detail that changes the conversation. Assets that couldn't be frozen kept functioning. Assets that couldn't be digitally erased retained value. What looked old-fashioned suddenly looked resilient, and that lesson didn't go unnoticed. Other nations are watching this closely, not ideologically, but pragmatically. If one strategy preserves sovereignty under stress, it becomes a template. Reserve composition stops being about yield optimization and starts being about independence. This isn't theory. It's proof, and proof travels fast in markets built on confidence. Once that realization spreads, gold stops being a hedge. It becomes infrastructure. And infrastructure, once adopted, doesn't get abandoned easily. There's a common mistake people make here. They assume gold only works when inflation is running hot, prices rising, money losing value fast. But history doesn't support that. In fact, gold's most powerful performance often shows up in the opposite environment. When deflation hits, debt becomes heavier. Every dollar owed gains weight. Cash gets scarce. Credit contracts. And that's when systems break. Not because money is cheap, but because it's suddenly too expensive. Borrowers fail. Banks absorb losses. Balance sheets deteriorate quietly, then all at once. Here's the key mechanism. In a deflationary collapse, capital doesn't chase returns. It flees counterparty risk. Anything dependent on someone else's promise becomes suspect. Banks, bonds, financial assets, even cash inside the system. Gold sits outside that chain. No issuer, no liability, no default risk. That's why it performed during the worst deflationary period on record. Not despite falling prices, but because of collapsing trust. This matters now because the system isn't choosing between inflation or deflation. It's flirting with both, printing to fight debt, tightening to fight instability. Either path stresses credit, and in both cases, the destination looks the same. Capital exits promises and moves toward permanence. Something else unusual is happening, and it's easy to miss if you're looking at old playbooks. Gold is no longer behaving like a hedge that moves opposite everything else. It's moving with them. Stocks rise, Gold rises, bonds wobble, gold holds. That shouldn't happen in a textbook portfolio. But this isn't a textbook environment. What you're seeing is gold being treated less like insurance and more like a core holding, not something you rotate into during fear, but something you hold regardless of mood. That shift changes how it trades and why it holds bids, even when risk assets look healthy. Here's why that matters. In past crashes, gold was often sold to raise cash. Margin calls forced liquidation. This time, that selling pressure isn't showing up the same way. Instead, accumulation continues alongside everything else. That tells you who is buying. Long-term allocators, not short-term traders. This breaks traditional correlations. It breaks risk parity assumptions, and it forces portfolios to adjust around gold rather than treating it as an accessory. When an asset stops behaving tactically and starts behaving structurally, price ceilings stop working the way people expect. And once that realization spreads, demand doesn't wait for fear. It arrives early. The buyer mix is changing, and that shift is doing quiet but permanent damage to old assumptions. For years, gold demand was dominated by price-sensitive buyers. Jewelry demand rose and fell. Retail investors came late and left early. That made tops predictable. This time, the center of gravity has moved. Strategic buyers don't care about entry points. Central banks don't trade momentum. Sovereign allocators don't wait for pullbacks. They buy to change balance sheets, not to time charts. And once those buyers dominate, downside becomes shallow and temporary. Here's the part that usually gets overlooked. When price-insensitive demand replaces speculative demand, volatility changes shape. Instead of sharp crashes, you get pauses. Instead of blow-offs, you get stair steps. The market looks expensive, but never weak. Now layer something on top of that. Retail and ETFs are starting to reappear, not as leaders, but as followers. That's the most durable combination in markets. Smart money builds the floor, late money lifts the ceiling, and notice what's missing. Hedge fund positioning isn't extreme. Leverage isn't stretched. There's no universal excitement. That's not how tops form. That's how trends mature before they accelerate again. Because once the broad public realizes the floor is real, they stop waiting for cheaper prices. They chase stability instead. The last pressure point is supply, and it rarely gets the attention it deserves. Gold isn't printed, it isn't scaled on demand. New supply responds slowly, over years, not quarters. And just as demand is becoming more strategic, supply is becoming more political. Governments are rethinking resource dependence, stockpiling, friendshoring, treating metals less like commodities and more like strategic inputs. That removes material from the open market without announcing it. The effect isn't dramatic, it's cumulative. At the same time, supply chains are being redesigned for resilience, not efficiency. That sounds responsible, but it has a cost. Redundancy raises prices, nationalization restricts flow, and once reserves are classified as strategic, they don't come back to market easily. Here's the uncomfortable insight. A market doesn't need a shortage to reprice. It only needs less flexibility. When supply becomes less responsive and demand becomes less sensitive, price stops being negotiated. It gets discovered. This is why volatility no longer scares long-term buyers. They're not waiting for more metal. They're waiting for confirmation that access will tighten further. And once that confirmation arrives, the market doesn't adjust slowly. It jumps. At the end of all this, one idea matters more than any number on a screen. Gold isn't rising because people are excited. It's rising because the system is recalibrating what it trusts. Currency, debt, and institutions are being repriced against something that doesn't rely on confidence to function. Every era has a moment where the old measurements stop making sense, where stability looks normal right up until it doesn't. This is one of those moments. Not loud, not dramatic, just structural, the kind that only looks obvious in hindsight. The mistake is waiting for confirmation from the very systems under strain. By the time they signal trouble, the adjustment is already done. Prices reflect behavior long before they reflect consensus. This isn't a forecast. It's an observation of alignment. Sovereigns adapting, institutions reallocating, individuals slowly catching on. Gold doesn't need to be perfect. It just needs to be outside the failure path. If you want to keep tracking how these shifts unfold before they're obvious, follow the channel. Because this isn't a cycle ending. It's a measuring system changing.